operations. This is the department responsible for issuing invoices, receiving invoices, sending payments, and making collections. This is key. Are the basic operations to make sure that the company has data to input into the accounting and all the finance department. Then, in the first level of the pyramid, we can see the compliance team. And this is subdivided in two types. Bookkeeping, who are responsible of making sure that all the invoices that were sent and received, and all the payments and all the bank movements that have been sent or received are translated into the general ledger, which means the accounting books. The accounting team will oversee their work and also add some more complex situations that may happen, like deferrals, amortizations, and other accounting adjustments. This base of the pyramid will take care especially of the past and the present, but the upper sections of the pyramid will take over the strategy of the company. And they will look forward to the future and also what to do about it and how we can play with the business drivers. In the first level of these two, we see financial planning and analysis and controlling. Financial planning and analysis are responsible of making the management accounts and the financial accounts. They are responsible of keeping track of all the expenses and all the revenue and distributing it in business line, countries, or any other dimension that may be interesting for the management, and also to forecast them. Whereas the controlling team will be the owner of overviewing everyone else that we mentioned until now, and also handle the relationship with third parties, with banks, auditors, potential new investors, public grant consultants, and situations like that. They will also be responsible of any special project that will help improve any process in the whole department. And on top, overseeing all this, it will be the CFO, whose role is to make sure that all of this runs, but also to provide financial advisory for the company precisely on how to finance the project and the future development of the company, and whose responsibility is to advise on the capital structure and make sure that the company will have the debt, the public funding, or the private funding that it will need in the future. Of course, this whole process needs to work very smoothly. If the information from the bottom is not correct, then we will have a wonderful process, but with garbage in and garbage out, and the information will be useless. This split of tasks will be different, obviously, in a tiny company than in a very large company. But still the functions exist, and each of these tasks should have a clear owner within the company. Distribution of these tasks depending on the stage. In early stage, let's say pre-seed or seed stage, the compliance and the finance operations are needed. The finance operations are often done by someone else in the company who has more roles, even the CEO, and the accounting and the bookkeeping is usually done by an external provider, which will be the case during even the whole life of the company. On the strategy, the financial plan and analysis usually is relatively easy, and it's often done either by the CEO himself or delegated to an external figure like an external CFO. On the controlling part, there's nothing or almost nothing to do, as the company is still not complex enough to handle third parties like auditors, like exchange currency providers, and things like that. The CFO role, though, is always needed. Is often the CEO, if they have a finance background, that can take over this role. But in any case, we always advise to count on external help for very strategic decisions. Even if it's a very early stage company, the founder has a lot at stake in any conversation with investors or in any planning of the strategy of the company, especially in terms of funding. For the growth stage, obviously the company is already a bit more complex. Often the finance operations is taken care of by a full-time figure or an office manager with a lot of time dedicated to this function. Then, still, the bookkeeping and accounting is outsourced. The financial plan and analysis is more complex, and the controlling is already more complex, so very often there's one figure within the company that takes care of it, or someone within the company that counts on external help for it. The CFO role is still usually not internalized unless the company is as complex as a fintech, for example, and it follows a very similar pattern that we described before. Although now the CFO will have a bigger role on cash management, investor relationships, and the strategy of the company, not only on funding strategy, but also on business strategy. If the company grows even bigger, like late Series B or Series C, then the whole finance department is usually internalized and with one dedicated person for each of these functions. Well, but for the accounting. The accounting very, very often, even in very late stage companies, is still an external provider. But some of the companies decide to internalize it as well. So there may be one person or even more in the finance operations part, then the accountants, as we mentioned, then one or more people on financial plan analysis, one or more in controlling, and an internal CFO that is needed full-time to run such a big team and to run the strategy of the company. Information is there, all the financial information only is there, and it's compliant with the law, and it's useful for presenting the annual accounts to the authorities, to presenting taxes, and to make sure that everything is well structured in a unified format by country manner. Obviously, it's a very important function. This usually doesn't add as much value as it could, especially in small companies. But certainly, not having it right will bring many problems in the future, not only potentially with the administration authorities of the country or the region, but also because it will be the base for the management reporting. And that one is essential to make decisions in the company. The management reporting not only compiles that information, but rather compiles it in a much more business-friendly way, so split by cost centers, regions, business lines, and so on. And also, it will have as an input KPIs from the business that are not strictly financial. Like, for example, how many new clients we acquired or lost in the last month, lifetime value, cohort analysis, and stuff like that on unit economics. The process to compile the financial reporting should follow more or less the trend of the pyramid that we already described. Obviously, the invoices need to be submitted and received and need to be paid or collected, for sure. And then that information should be accounted for by the bookkeepers on a constant basis, on a continuous basis during the month, not only at the end of the month or not only quarterly, but continuously. And the accountants should review that and make the accounting adjustments that should be input in the accounting, that only at least once per month. Certainly not quarterly. It should be, if anything, a monthly process. With that information will be reviewed by the business, but still it should be contained there and allocated in the right accounts and everything following the compliance to the law. This should happen in the very first days of the month. If the accounting has been done properly and continuously, in the very first days of the month, we can already have a pre-closing of the last month. If that pre-closing obviously needs some review, it's fine. And then some back and forth with the company should happen. But then between the day 5th and the 10th of the month, that should be ready. The management reporting can use those first days of the month to also acquire the business KPIs that are needed in order to compile it for the new month. They also will be the ones that interact to make sure that the financial reporting is ready. Because once it is ready, the accounting should be the basis, always, for the management reporting. They will input, as I mentioned, many more information, like the KPIs of the business, the splitting cost centers, the splitting regions, and many things that may not come from accounting. But their process should last maximum up to the 15th day of the month. At that moment, the management, and again, as early as possible, the better, the management will be able to review all the documentation and may be able to make decisions for the business being data-driven and may be able to forecast the coming months, having one more month of actuals and new hypotheses to follow. Therefore, being data-driven, it's obvious that you can have a much better strategy and much more control of the company than if you don't have the accurate data, if you didn't follow the right process, or if the data arrives too late. the information should give us much more useful information to run the business. So, for the P&L, it has the revenue split in business line and the cost of sales split on business lines, which will give us a margin split in business lines. This is extremely important. If a company has both software and consulting business lines, it is very likely that the gross margin in each of them is very different. And if you track both of them as if it were a single business line, like the financial reporting usually shows, then you will find yourself making an estimation of the gross margin of the blended that may not give you the insight you need to see the real gross margin in the two business lines. This is extremely common for many of our clients. And afterwards, you go on to the fixed cost. And we always recommend to split it in personal cost and operating cost, but making a lot of effort to distribute the personal cost in different cost centers. This is extremely important. The usual financial accounting puts all the personal cost in one single line, and you don't find the split. In a normal startup, around 80% of the fixed costs are staff of the company. And if that's the case, obviously you want to see the detail between to see how you are spending it. It is not the same to say that 80% of your staff cost goes to marketing and sales, or that 80% of your marketing and of your personal cost go to tech and product. It's a totally different picture, and you cannot be blind on that important topic. The other operating expenses that are not personal expenses should also be split in cost centers to allocate the responsibility to the different departments. With this, we will get to an adjusted EBITDA. And the reason why this adjusted EBITDA is different to the EBITDA of the company is because we are allowed to leave some of the items after adjusted EBITDA. For example, a funding round may have like several lawyers' invoices that add up to a huge amount. It doesn't make sense to say that your business operationally had a very bad month because just that month you had the lawyer invoices, for example. Or there are many accounting adjustments made at the end of every year, dated December 31st, that usually don't involve really like different business practices. This is very important, and in any case, again, we should get to the same EBITDA than in the financial accounts. When reporting cash flow, we do not recommend to report it like corporates do. We do recommend a split on operational cash flow and financial cash flow, but we prefer to calculate it in a reasonably sized startup on a line-by-line item on the banks of the company. And we split it usually, the operational cost, in collections, operating cost, sales cost, and Kpis, and personal cost split as well between the net pay, the social security, and the salary retentions that often follow a different monthly trend. Also, we add there the recurrent taxes, like for example VAT, that is often monthly or quarterly. Then we report separately the financial cash flow. It's important to split it because it's not the same to analyze how much cash do the business generate or lose compared to how you're financing it, which may be through capital increases, debt, grants, and some others. That should be allocated separately. With this, we can see the net cash flow, the cash position, and in many companies, it's important to add also the available cash. If the company has a credit line that is not maxed out, then there is more cash available than it may seem at first sight. And one of the pieces of the reporting that is more important, especially in a startup, is the KPIs, information that don't come from accounting or that you need accounting information to be combined with business KPIs in order to get a reasonable and meaningful new KPI. In a SaaS company, for example, the MRR and its drill down is absolutely essential. In any startup, the net retention, one way or another, is absolutely important and should be kept track and should be also forecasted accurately in order to make the right decisions in the future. And of course, like we have insisted in previous courses, the unit economics and the efficiency metrics are absolutely key. So they also should be included in the reporting forecasted reasonably in order to make good decisions for the company. With these three sections, we have compiled something that is extremely valuable for the management, and it's the valuable information that the investors should have to analyze the company they invested in. And it gives much more complete business information than just the financial reporting. Forecasting that the conversion from the leads to signatures is going to be 20% in the coming months, but you don't have the figure available or you don't have it in the same report of what happened in the last month, you may be doing a very optimistic or a very pessimistic forecast and you don't know it in the way. Also, the reporting the forecasting should be very flexible, and for companies that are not still in Series B or Series C, often Microsoft Excel or Google Sheets are good enough. We would prioritize flexibility over power for a company that is small and that very often keeps pivoting or changing their business decisions. This consistency with reporting cannot be emphasized enough. It should be comparable line by line what you forecast and then what you report, both to make an accurate forecast and both to compare with your hypothesis once those months have passed. Another part that is very important when doing forecasting is the realism and the continuity of these KPIs. Very often we see forecasts done by our clients before we started working with them, in which their most important business drivers have been flat for many months in the past, but from the future they are going to be much higher. And this may be true, and this may make some sense, but there are two very important principles to keep in mind here. First is that very often the best forecast for a business driver is what has happened in the past. So at the very least, we want to forecast a scenario in which we see that the business drivers of the business, meaning new clients, meaning churn, meaning any other, will remain the same, at least as the pessimistic scenario. And then, if we consider that these KPIs will have an important shift upwards, there must be some cost involved in it. There must be some investment that justifies that once you do it in the future, your churn will be reduced or you will be able to acquire more customers. This is very important as well, and very important tool to avoid wishful thinking when doing the forecast, which is very tempting to any founder or any entrepreneur. And also, the last best practice that we wanted to share on the structure is to track unit economics and track efficiency metrics. It is very easy that you start forecasting and having like different lines on your P&L forecasted independently, but when you add up all of them, they may not make any sense. For example, if you didn't forecast that your sales and marketing cost will grow significantly in the future, but you are forecasting that your acquisition of new customers will grow a lot in the coming months, you may see that in the future, your ratio of lifetime value over customer acquisition cost, LTV over CAC, is unrealistically high. In that case, you should reanalyze and probably say, okay, if I want these new customers, then I will need to spend more on sales and marketing, or the other way around. This is also extremely important. In paper, everything checks out, and whatever number you input in an Excel file probably will not break the file. But this doesn't mean that it makes business sense. And it's very tempting for many founders to think that reality will follow their Excel file, but rather it should be the other way around. It should be data-driven. So let's try to avoid any hypothesis in the future that just comes out of nowhere, but rather let's try to drill them down as much as possible. It's better if you say, I think in each business line we are going to have this growth because of this hypothesis, rather than just estimating like the revenue will grow by 20% next year. The more you drill down the problem, the more you're adding hypotheses to the problem, but it's very likely that like some of them will cancel each other and give you a much more accurate information than if you just do it top down. The forecast should be updated constantly. it is a mistake to have a single forecast at the beginning of the year set as a business plan and just compare against it and just assume that the last months of the year will follow the forecast you made at the beginning of the year. But rather, every month, right after the management reporting, should be the starting point for the new forecast. This is especially important in a startup in which situations change constantly, in which there is a lot of uncertainty and business decisions and pivoting happen on a weekly basis. The KPIs should be integrated as much as possible on the equation and tracked and forecasted with the same amount of importance than the financial information. Then the cash flow, especially in a startup, must be really well forecasted. It is very important to count on delays for collections. This is something that many startups tend to forget, but especially if it's a big ticket or with a big corporate company, the expected collections will come probably in 1, 2, or even 3 months. Something that is very important for forecasting is to try to move everything to a visual point of view. It is very easy that with so many numbers in front of you, you may be forecasting something unrealistic for like 6, 12, or 18 months from now. But if you see it in charts, it's much easier that you see the deviation at just first view. And also, something extremely important when doing the forecasting exercise is to make sure that you coordinate with the other teams. Again, the personnel cost is often 80% of the fixed cost, and the operating cost will always have a manager that is responsible for that budget. This cannot be done or cannot be expected by the finance team alone, but rather the finance team should collaborate with every other department in the company. The finance team should not be the bad cop and the guy that says no hidden in a corner of the company, but rather it can have a very active role, speaking proactively with all the departments and compiling that information to have a reasonable forecast for the management team. In that sense, the finance function, regardless is taken care by a single person, external or not, at the beginning, or by a full team at the end, is always and will always be one of the core functions of the company.